Chavez. Thank you everyone for joining. My name is Mike Chavez. I am a national educator for Veterans Lending Group. I also am a licensed mortgage loan originator, even though I don't originate loans anymore. That is my personal contact information. That's my personal cell phone number. You can use that QR code to scan in a digital business card of mine, and we'll get going here. So a little bit more about me. I'm married, I mentioned, my wife who likes to be late. We have 3 grown boys. I was in the U.S. Army. I was stationed in Alaska and here in Colorado Springs. I graduated. I got a master's degree with USC. They have a program called the Master of Business for Veterans. It's the only program of its kind in the entire country. It serves exclusively active military and veterans. So if you want to know more about that program, hit me up or put it in the chat. Happy to give you more info on it. It's amazing. 10-month master's program. You knock it out really quick. It is pretty intense, but it was an amazing experience. You're talking about credit, budget, things like that. Happy to answer questions on homeownership and how to navigate all that stuff. I am a real estate owner and investor. I've bought my first house in 1995 and have been investing ever since. I do short-term rentals, long-term rentals, Airbnb, VRBO. So if you want to hit me up with questions regarding that, happy to answer because it's a great way to supplement your income. I think that's it. Let's get going. So the first thing I want to say before you get started. So there's 2 sites. There's the National Do Not Call Registry and the optoutprescreen.com. When you go to apply for a loan and they pull your credit, the credit bureaus then take your information and sell it to a bunch of people. So you're going to get a ton of calls, going to get a ton of mailers, things like that. We have some clients that receive up to 50 calls a week. So if you don't want that to be slammed with that, I'll put the links in the chat here and you can opt out of all that stuff. It's a great idea to do, especially at least a month before you apply for a loan, but it's even just good for peace of mind. This class is broken up into 4 different parts. So this is a slide of the median sales price of homes sold in the United States from 1963 through the middle of last year. And as you can see, there's like a trend line here. It averages out to about 5.5% average annual appreciation on homes ever since 1963. The reason why I don't want to show this is because I want to kind of guide you away from trying to time the market perfectly, because there's a certain advantage of timing it, right? Either if you're looking for prices to come down or you're looking for interest rates to come down or a combination of the 2. Yes, you can save a little bit, but as long as you're looking to buy and hold and not looking to buy and flip it within, 6 months, a year, whatever, it kind of doesn't matter what the current market is doing, right? Because it's going to go up. Yeah, you might save yourself a little money if you time it perfectly, but think of it this way. Right now, in most markets where most sellers are only getting a handful of offers, sometimes none, sometimes you're the only one making an offer, right? So you got significant leverage, and particularly if you're working with a realtor who has strong negotiating skills, they can negotiate for the seller to pay your closing costs and things like that, right? Or give you other concessions. But what happens when prices drop or when rates drop, right? Then you have a lot of people that are on the sidelines jumping back into the market. What happens when you have a large group of people jumping back in the market, right? Now you have competition. Now you're dealing with multiple offer situations and offering above asking just to stay in the game. My wife and I, before I moved here to Colorado Springs, back in 2021, we were trying to find a home. We put offers on 6 different houses, all above asking, and we didn't even get a call back from any of them. It was just a crazy, crazy market at the time. So we ended up doing a new build. They did a lotto system and we got the last house available. So we got pretty fortunate, right? Whereas right now, you have much more stronger negotiating position than we did back then, right? So just keep that in mind. Or if rates are high, you can always refinance when the rates go down, right? Just keep that in mind if you want to avoid some competition. Does it cost more to buy? Is a common question I get from people. And the answer is it kind of depends. I want to run a scenario here. Let's say average rent in the United States is around $1,900 in 2024. So that averages out, it's approximating a loan amount, or it'd be equal to a loan amount payment of $320,000, assuming 6% fixed rate assuming taxes and insurance like here in El Paso County, because every county is different, right? Where your tax rates are different and your insurance, depending on Southern California right now, their insurance premiums are going to skyrocket. In other parts of the country where they have natural disasters, Florida, you have a lot of insurance carriers pulling out and denying coverage or not renewing people. So there's that issue. It's about $320,000 loan amount. One thing to, as a shorthand calculation, for every $10,000 change in the loan, so if you go from 320 to 330, you're making your payment go up about $70 a month, right? So just keep that in mind and give you an idea of how to estimate what your mortgage would be based off of the loan amount. I'm looking at 5.5% average annual appreciation if you buy. With rent, nationally, there's also a 3.7% average annual rent increase each year. So on this scenario, you're looking at a $300,000 home, 6% fixed rate with $10,000 down. Your payment would be about $2,000 a month. So I'm starting with your rent and your payment, and that includes tax insurance. So over the next 10 years, if you were to rent, you'll be paying just about $284,000 during that whole 10 years, and your rent has gone up 40%. You started at $2,000, now you're at $2,774. If you were to buy now in 10 years, you'll have paid out almost the same, right? $251,000. It's a cash flow savings about 33%, but your payment has only gone up 9% other than 40%. So you're still paying just under $2,200 bucks, but it's better than $2,774, right? But that's just like the tip of the iceberg. The real payoff comes in this next section. One, during that first 10 years, you've been making payments, you're paying down your mortgage. So over that first 10 years, you paid almost 50 grand principal reduction. Your home has appreciated over $200,000 during that period because of that 5.5% average annual appreciation we talked about, giving you a little over $250,000 total equity. So if you add the equity plus the cash flow savings, you generated $285,000 of wealth by buying instead of renting. And that's just in 10 years, right? So if you're starting young, like I did, you're looking at 30 years of time before, 30, 40 years before you retire, you're generating significant wealth renting versus buying. There's also tax incentives for owning a home as instead of renting. You could deduct property tax, mortgage interest, things like that. If you have a VA disability rating, usually it's 100% permanent total. Depending on what state you're in, you can be exempt from paying property taxes either completely or partially. So if you're looking for more information on that, we can chat afterwards. There's also tax-free incentives. Remember, you're building that equity in that home. When you resell that home, your profits from that up to $250,000 if you're single and up to $500,000 if you're married, you get tax-free, which is, I'll tell you, as a John Q. Public working for ABC company, you know, making an hourly or hourly wage, there are very few tax incentives for us. You know, there's tons of tax incentives for the rich. I won't get into that. But John Q. Public, they don't get very many. This is one of the most powerful ones there are. I want to go into a situation right now, but one caveat is that you must have owned and lived in that home a minimum of 2 of the past 5 years. So if you own the home and then you decided to upgrade, right, and then you start renting it out, you basically have another 3 years to rent it out before you sell it in order to take advantage of that tax-free profits. If you don't, and you just end up keeping it for life, right? So here's an example. So this is my home, or my condo that I bought in 2000. I bought it for $89,500. It's right there, boom. That's when it was last sold. I looked it up today, and on Realtor.com, estimated home value 502. And keep in mind, it's an estimated value, right? Not necessarily exactly what it would sell for. It could sell for higher, it could sell for lower. But this is just as education tool, right? Over that time, it's 25 years now, I had paid down $62,000 in that principal reduction, just making those monthly payments. The original payment was like $660. It was pretty ridiculous, right? But not only that, it appreciated over $412,000, giving me almost $475,000 in total equity. And my average annual appreciation is not 5.5%, but 7.14. When I'm talking about the average annual appreciation, that's taking the average appreciation from all markets across the United States. So some are going to be higher, some are going to be lower, but this is this specific case, right? This is what I'm experiencing. So right now, I'm currently doing a long-term rental for this property. The people that are renting it have been in there for 2.5 years. They absolutely love it. I love it because there's no turnover. There's an annual inspection I do just to make sure that the house is kept in good order and any repairs done or changing filters and that sort of thing, right? So I just wanted to show you that as a real world example of one of my properties. What also sucks is that so much of the new builds are not starter homes, right? So it's just like, yeah, they're not catering to people that are just starting out and trying to buy their first home, right? But there's different strategies for that, and we can get into that. But it's a great point. It's much less affordable now than it was, even 10 years ago. So, monthly housing costs. There are 4 main components to housing costs and with an optional 5th, right? The first is your principal. This is your balance on the mortgage. That's part of your mortgage payment that are going towards paying down what you owe on the property. Then you have the interest. This is the amount that the lender charges you to borrow the money. And when you first start making payments, this is usually the largest portion of your payment. It goes toward interest. Then you have taxes, property taxes to the county that you live in. And so it could vary widely. In California, property taxes are very high. In other states, they're pretty low. Texas is really high as well. And then you have homeowners insurance. This is to protect your property. It's required if you have a loan on the property, you're required to hold homeowners insurance, and there's some minimum requirements of coverage. And then 5th is any HOA fees. Whether you're a condo or you're a single family residence in a community. We are in one now. We had a home built, but it was built in a development. So there's an HOA fee. One thing to note though, the HOA fee for a home, I'm paying like $142 every quarter. For my condo in California, I'm paying $300 a month for HOA fees. So your HOA fees can vary greatly, but tend to be much higher if you're purchasing a condo other than like a home. So just keep that in mind. So how much house can you buy? First thing we're going to look at is 2 calculations. One is called the front end debt to income, where we take what the total housing cost would be. Remember those 5 things I mentioned: the principal, interest, tax, insurance, and association fees. Then we're going to divide that by your monthly gross income. And that ratio or percentage needs to be under a certain point, right? If it's higher, then you won't be able to afford that home in the eyes of a lender. The other ratio we're going to look at is your back end debt to income, where we take your total monthly debt. This is like your car payments, student loan payments, credit card payments, all that stuff, in addition to all the housing costs, divided by your monthly gross income. And that also has to be under a certain threshold for most loans. So how does that work in practice? Some limits per program. The VA does not expressly have DTI limits on the front end and back end, but they tend to be around 50 to 60 max, right? So just keep that in mind. And then here's the front end and back ends that are common for conventional FHA and USDA. So as a practical, let's just say as an example, you had a $10,000 monthly gross income. You also have $2,000 in monthly debt payments that are not housing related: home loans or student loans, car loans, credit cards, things like that. This is what you can expect to be your maximum monthly payment per program. Conventional would be the lowest. Your back end, you could afford a mortgage of just under $3,000. Whereas with VA, you'd be able to get approved for a loan for up to $4,000. That's why it would differ between what program you're going under, how much of a house you can afford to buy or get approved to buy. So here's another example. You have a $4,000 a month principal and interest and tax and insurance payment. Again, I'm using the El Paso County rate and the average insurance rates here. So depending on what rate you lock in, and just as an example, like a fixed rate, if you get a rate as low as 4%, you can afford a loan of over $700,000. But if you had a high rate, like of 8%, particularly if you have low credit score, it really cuts down on the amount of money that you can borrow. I mean, under $500,000, that's a $225,000 swing, all based on what rate you qualify for. So when you go to buy a house, there's three scenarios when it comes to rates. You're either going to get a no cost rate, which is that green line there. And in this example, that no cost rate is 5.75. So there's two options. Yeah, and you probably have heard this before. You can buy down the rate, right? So if you're looking to buy down the rate, and basically since the rate is on the X axis, you would go down, right? So as you go down, you can see the cost of that rate going up. And in some circumstances, there might be scenarios where a lower rate would be lower cost than a higher rate. See that at 5.5 or a 5%, it only costs you 2% of the loan amount, whereas at 5.25, it would be 3%, right? That's some things that happen because rates aren't exactly linear. It really depends on that sweet spot. That's why you really need to work with a loan officer who can walk you through that and have that discussion about what is the best scenario for you. The other option is if you were to elect to get a higher rate than the no cost rate, you can actually receive a credit that you can then use to pay like toward your closing costs. Particularly if you don't have a ton of money to go toward closing costs, it's a great way to help cover those costs in order to get, so you would just initially get that higher rate and then refinance, a year or two down the line when rates drop and you could lock in a much lower rate. That could save you a ton of money. So just different loan scenarios. So there are four main categories. It's the 4 C's of loan approval. We're going to look at your credit. That's kind of obvious. History of your ability of repayment on your debts. We're going to look at your capacity. This is your ability to repay on that loan. So we're going to look at your income and debt. Remember those debt ratios, debt to income ratios we talked about? We're going to look at your capital, what cash you have on hand. Because that if you have cash on hand or in reserves, it shows to us, the lender, that you're not living paycheck to paycheck. When you think about earnest money, when you make an offer on a home, any down payment and closing costs. So having cash on hand to be able to cover those expenses really helps you in the eyes of a lender. And then finally, collateral. We're going to look at what you're securing for the loan. And this is typically, in this case, would be the home itself. So we need to do an appraisal, get the fair market value of that home in order to determine if, in the event that you default, could we resell the home for what you owe. So another question, is my credit good enough? Well, it really, again, it depends on the program that you are looking to go under. So typically, you're going to want 12 months of clean credit no matter what program you go under. So 12 months of no late payments, no judgments or collections against you in the past 12 months. With conventional, typically, most lenders have a minimum requirement of 620 or 640. That's pretty typical. Very rarely you'll find one that will go as low as 580. With FHA, you can go as low as 500 as a government program, but you want to be 580 or above in order to avoid a higher down payment. We'll talk about that shortly. With VA, and most lenders, again, anywhere from 580 to 620. But here's the kicker. The VA itself does not have a minimum credit score requirement. If you talk to a lender and the lender does have a requirement, it's because the lender had put on what's called in the industry an overlay on top of what the VA's requirements are. So if you are a VA and you're looking to get a loan, work with a VA specialty lender that does not have that overlay. It's better help you qualify for the loan. So how does a bad credit score affect buying a home? There's a few different ways, right? You will, if you get approved at all, because if with a lower credit score, you could get denied just based off the credit score itself. But even if you are approved, you are looking at higher rates and potentially private mortgage insurance on conventional loans. It doesn't matter what your credit score is when it comes to whether or not you pay private mortgage insurance. Private mortgage insurance starts if you're putting less than 20% down on a home. The difference comes in is the rate that they charge you for a conventional loan, private mortgage insurance, is based off of your credit score. So the lower your credit score, the higher your mortgage insurance premium is going to be. So just keep that in mind. The second thing we're going to look at, if you have a lower debt to income ratio, here's an example, $5,000 income, 6.5% rate, 0 down, 30-year fixed rate loan. Your debt to income ratio would normally be 50% in DTI, which would result in like a $2,500 payment, which translates to a $350,000 purchase price. Alternatively, if you had low credit score, the lender may not approve you if you had a 50% DTI. They may require a lower DTI of, let's just say, 40%. In that case, it reduces your purchasing power. It only will approve you for a $2,000 a month payment, which translates to a $275,000 purchase price. So you just lost $75,000 in purchasing power because of a low credit score. So that's a way that it could affect you. Compensating factors. If you have a low credit score, they may require you to have higher reserves, like cash on hand. They may require you to come up with a larger down payment, things like that, right? So it's just going to cost you more out of pocket by having a bad credit score. When it comes to budget, this is really hits me close to home, right? So there's a bunch of ways to do budgets. My personal favorite, being a financial coach, is the 50-30-20 rule. Whereas you budget the most 50% of your income on needs, which include housing, 30% of your budget on wants, and then 20% that goes towards savings and paying down debt. So, don't I need 20% down payment? You may have heard that, particularly with conventional. The down payment minimums for a conventional, if you are a first-time home buyer, is 3%. If you are a subsequent purchaser of a home, you're looking at 5% as a down payment minimum. FHA, this is where that credit score comes into play. If you have a 580 plus, that your minimum credit score or down payment requirement is 3.5%. But if you go below that, all the way down to 500, your minimum down payment requirement is 10%. So that's a significant difference, right? 6.5% extra that you may not have. Even a $400,000 home, that's 40 grand. So it's a big difference. With the VA, they do not have a minimum down payment requirement for almost all loans. And we can get into exceptions during the chat Q&A if you'd like. So what about private mortgage insurance? We did touch on this a bit. If you put down less than 20%, you will be paying private mortgage insurance with a conventional loan. And these rates can vary from anywhere from 0.58% to almost 2%. And it's going to depend on your credit score. So if you have really great credit, you'd be looking at that 0.58. If you have really bad credit, you'd be a lot closer to that 1.86. And that could make that payment much higher. So just keep that in mind. FHA does things a little more complicated than conventional. They take two things into consideration. They take the loan amount. In this case, just do $726,200. I'll have to update this because I do believe the minimums went up like $806. But just for education's sake, we're all going to look at your down payment requirement. So if you have a down payment of less than 5%, this gives you a table of what you would have to pay as your annual mortgage insurance premium that they just charge monthly, and then they adjust it every year. But with FHA, not only do you have that monthly payment, you're also going to have to pay an upfront mortgage insurance premium at closing, and that's an additional 1.75%, and that's flat no matter what type of loan you get with FHA. So just keep that in mind. FHA is a great program, particularly if you have low credit, because FHA does not penalize you nearly as much as conventional does for having not perfect credit. So down payment assistance programs. These can be very valuable, particularly if you don't have a ton of money to put toward a down payment. These are some of the down payment programs that are here locally at Colorado Springs, but there are over 1,800 programs out across the United States. So if you're interested, you talk to a loan officer and they can connect you with a down payment assistance program if that's something that you're interested in. I also want you to consider these down payment assistance programs. They are not condition free, right? So one, it can limit the number of lenders that you can work with. They may have additional requirements and conditions. Almost always they will. Extra costs and fees, it's just part of the program. You may have to pay extra fees in order to get that down payment assistance. There's also some minimum credit score requirements on a lot of these programs, which may push you out of being able to purchase that home to begin with, because that minimum credit score requirement might be higher than the program like FHA conventional that you're looking to purchase. Your costs may increase over time, because if that down payment assistance is a loan, that cost of that loan could be more expensive over time. You're looking at a longer closing process in most cases, because now there's another party involved in the transaction, and down payment assistance programs are not known for their speeds. Just Just keep that in mind. There's also residency restrictions, particularly, and the most common is like you have to live in it as your primary residence for at least 10 years. And if you sell it or move out before the end of that 10 years, there can be some major penalties involved in that, or having to pay back that loan in full. So just keep that in mind. There are some restrictions on down payment assistance programs. So closing costs, particularly like with VA, just because there's no down payment requirement does not mean there are no closing costs. There's a lot of negatives in there, double negatives. Basically, there is going to be closing costs. All the third parties are involved in this transaction. Your escrow company, realtors, if you have them, your lender, your appraiser, your inspector, all these people need to get paid. So these costs are normally split between the seller's cost pays for certain things and the buyer pays for certain things. And that could vary on the state that you live in. So I just want to focus on the buyer portion right now. So there's 4 options that you have as a buyer. You pay out of pocket through the reserves that you have, right? Cash on hand. You can receive a gift or a grant. As long as it's a true gift or grant, we'll need a letter from the person giving you that money stating that there's no expectation of repayment. You can get a personal loan. There's a few downsides to this. 1, your interest rate is going to be much higher. And number 2, that minimum payment for that personal loan will be counted against your ability to pay the mortgage. So just keep that in mind. And finally, you can negotiate in the purchase price with the seller. And I'll get into that in just a second. On the seller side, they can actually elect to pay part or all of your closing costs, 1, out of the kindness of the heart, meaning out of their own pocket. Usually when you close on a home, whatever profits they make from the proceeds of the sale will go toward paying your closing costs, or a portion of that will go toward paying your closing costs. Or you can negotiate your purchase price. How does that work? Well, programs are a little different, but like in the case of VA, the VA requires an appraisal done on the property. So let's say you're looking to purchase a home for $400,000 and there was $10,000 of closing costs. If that home gets appraised for at least $410,000, you can then offer the seller $410,000 of purchase and ask them for a $10,000 credit to go toward your closing costs. You're essentially financing your closing costs into the loan amount itself. And that's one of the ways that you can do it. So it's a strategy, particularly if you're strapped for cash, a way to close on the loan without having to pay out of pocket. Also, when it comes to seller contributions, there are limits of how much they can contribute, and it's based off of the program. I'm not going to get all into that. There's a lot of information on this. Just take a screenshot of it, depending on what program you're interested in pursuing. But the VA is most lenient. It basically breaks down closing costs into 3 different categories. And as long as the closing costs are not in those 2 bottom discount points or the prepaid stuff, it's unlimited the amount of closing costs a seller could pay for on your behalf. Part 3, what's the process? So 5 steps. So take out your notebook. First thing you're going to do is meet with the lender and apply. The reason why I suggest meeting with the lender prior to talking to a realtor is because a realtor loves to have a home buyer that is already pre-approved, because they know you have already gone through the financials and all that, and what you're looking for you can afford to buy. Realtors hate showing properties, but only to find out that you can't afford to buy it in the first place. So meet with a lender, avoid the heartache. You want to meet with a mortgage loan originator that you like, you trust, and have a ton of knowledge about your loan options and can walk you through those options. So what we're going to do is, as a lender, we're going to give you a pre-approval letter. It's a detailed review of your entire financial situation, where all the information that you had submitted when you applied, we're going to document and verify all that stuff and get you approved for a loan up to that amount. With that letter, you can then go shopping with confidence, knowing that you can purchase up to that limit. A pre-qualification letter, by contrast, is much easier to get done, but there's some major downsides. Yeah, we could do it in less than 20 minutes. We just take the information you gave us. We're not verifying or documenting anything. We're basically just taking you at your word of what your entire financial picture is. And you get a pre-qualification letter saying that based off of the information you submitted, you can expect to be approved to borrow this much money. But you can still be denied for the loan because nothing has been verified, right? If you go shopping based off a pre-qualification letter, realtors get very antsy about that as well. because they know that you may still get denied for that loan. So keep that in mind. So second step, this is when you're going to connect with a real estate agent if you choose to. This is an optional step, but if you choose to use one, find one that knows the local market, understands your particular needs and situation. You want one that can negotiate on your behalf and do so very well, because that could save you thousands, if not tens of thousands on the transaction, either on the purchase price or on concessions that you get from the seller. And you're going to make an offer, but during this whole time, you're going to want a real estate agent that will answer your questions, because this is a major purchase, one of the biggest purchases you'll ever make in your life. So you are going to want a team behind you, the lender and the real estate agent, if you choose to use one, that can answer all those questions and give you the information you need in order to make an informed decision. We have a whole network of agents. You don't have to use ours, but we could throw them into the ring. And so you could shop agents because their commissions are negotiable. The whole NAR settlement, found a lot of abuses where it was just like, oh, it's standard 3%. No, it isn't. It's always been negotiable. And now they have to tell you that their fee is negotiable. So it's in your best interest to talk to a few of them and pick one that works the best, that's aligned with you for reasonable cost. Step 3 is mutual acceptance. I have here seller accepts offer, but that's only one scenario. You can make an offer and the seller doesn't agree, but they could counter offer and you can agree to that. The whole point is you both agree to terms, what the purchase price is and all that stuff. Are you locked into an agent? Yes and no. You are locked into an agent the moment you provide your John Hancock to a contract. And most agents will pressure you to sign a contract as soon as possible because they want to be locked in. They don't want you shopping agents. So once you sign on that dotted line, do not shop for agents anymore, because even if you choose another agent, that original agent can still get paid. So it's just in your best interest to shop before you sign any documents with agents. So just keep that in mind. After you come to a mutual agreement, this is where you're going to sign initial disclosures. Us, the lender, are going to give you some documents for you to review. It's basically stating about your rights that you have during the whole process. It's going to state all the estimated costs that we can expect you to pay either at closing or like your minimum payment and things like that. You're going to get all that information up front. And then you have the option to order the appraisal. If you are a conventional FHA with VA, you must have an appraisal done. And the timing of that could depend on a few different factors. Normally, you would want to wait to order the appraisal until after the inspection is done, because the inspection may come up with things that you just can't live with, whether it's termites or black mold or whatever. You'd just rather not deal with it, because once you order the appraisal, you're on the hook for the cost of that appraisal, whether or not you purchase the property or not. So typically, you want to wait till after the inspection. In some cases, it may be in your best interest to order the appraisal earlier than that, particularly if your closing time is very short or the appraisal time for the county that you live in is fairly long. Usually it's a week, but some counties are as long as 3 weeks. So if you're in one of those counties, it might, especially if it's a very rural area, their turnaround time can be much longer. So it may be in your best interest to get that appraisal out as soon as possible. Note that the appraisal is not a home inspection. What it does, it assesses the value of the home. And it's also looking at 3 different things, whether it's safe, sanitary, and sound. It's not an in-depth review like a home inspection is. It's just making sure that you're moving into a livable home. Home inspection, on the other hand, is a detailed review of the entire property. They're going to go look under every nook and cranny. You're going to get a report. One of my properties that I bought as an investment property, I paid all cash. And I got this report that was like this thick. No freaking joke, man. This guy was just like, I've never seen a more meticulous report. It identified so many little things. You know what we did? We went back to the negotiating table and say, hey, look, there's a ton of things wrong with the property. You either need to give us a discount on the purchase price, or you need to resolve all these things before we close. And that was a great leverage tool that it gave us in order to negotiate better terms. So home inspections are fantastic. It gives you an exact idea of what you're getting into prior to purchasing the property. And the lender can't loan you more than the appraised value. Kinda yes and kinda no. For the base purchase price, if you were to get a renovation loan, that's combined with that purchase loan, you can actually go above and beyond the purchase price of the home because now you're financing repairs made to the home as well. Also, the funding fee for the VA. Since that funding fee could get rolled into the loan, your total loan amount can be higher than the appraised value of the property. But in general, there are caveats to that and there are exceptions. So step 4, do nothing. You would think, I tell this all the time, you would think that this would be the easiest step of all the 5 steps, right? Do nothing. But this is where people that fall out of a contract do so because of this step. Think of it as a credit freeze from the time that you get pre-approved to the time that you close on the home. Not just when you go on a contract, when you get pre-approved, because you get pre-approved based off of the condition of your income and your debt at that time. If those circumstances change, meaning that you go into more debt, you go buy that Cybertruck that looks hideous, or you go buy a boat, or you start purchasing all the furnishings for your new home, right? If you go into more debt, that can and will be used against you, not in a court of law, but in us, the lenders, in our eyes, right? We're going to look at it, and that could prevent you from getting that home because it could negatively impact your credit, because any new credit actually lowers your credit score, and debt will definitely lower your credit score. It could negatively impact your debt to income, those ratios we talked about earlier. You could lose out on the home. Nobody wants that. Us as a lender, we only get paid in the event that you close on the loan. We did all this work. If you fall out, we don't get paid for any of our time. The realtor who showed you all the properties and did all the contracts and all that stuff, they don't get paid. So it's in everyone's best interest to see this deal happen, right? And you don't want to lose that home that you had your heart set on purchasing. So we do understand, though, that life loves to kick you when you're down, right? So if you have a financial event that's unavoidable, like your car gives up the ghost or whatever, and you need transportation to go to and from work, talk to us, the lender, before you make any major purchases, because we can figure out a way to make it work. If there's a temporary solution of either taking Uber or public transportation to work temporarily until you close on a loan, and then you could go buy your car or your Cybertruck, whatever, do it after you close. We'll work with you, but you have to be open communication with us, okay? And then step number 5, this is when you're going to sign and close the deal. This is the best step. You're going to sign the loan and the closing docs. You're going to sign all those documents that are required to close the loan. You're going to get another stack of paperwork to sign. In some states, you can sign and close the deal on the same day. Here in Colorado, we could do it the same day. Actually happens at the same time. Basically, as soon as you sign all the closing docs, the deal is closed, you get keys to the home, all that good stuff right away. But if you live in other states, they can separate the two between 1 or 2 days, depending on what state you're in. If you need more information on that, we can connect you with the lender and go through your specific state and scenario. So part 4. So after you buy, I want you to have this as a mental checklist. You want to review and update your homeowner's insurance policy. You're going to look at your coverages, liability, your deductibles, all that stuff. Make sure that it's manageable and what you need. Because what you need as a minimum requirement when you close on the loan, when it comes to coverages, may not be what you ultimately want. You may want lower or higher deductibles or more coverage when you find out that you have more jewelry or stuff that you want to get insured or covered for a little higher premium or whatnot, right? You also want to look at utilities and service providers, electric, gas, water, all that stuff. Lawn care, if you, like me, I am severely allergic to grass. So we end up getting artificial turf, which looks gorgeous all year round. But it's just because my allergies can't handle it. Before we got this house, we had to pay for a landscaper. Home security, if your home doesn't have already, but alarms, cameras, smart locks, join the neighborhood watch, things like that. When it comes to legal and HOA, make sure you read your HOA docs, if you have an HOA, very carefully, because they're going to tell you what you can and can't do with your property. I always recommend joining the board just so you can have a hand on the wheel of the direction of the HOA. I've always joined my HOA boards and never regretted it, even though it could be a little bit of a hassle sometimes. Home improvements. Once you look at renovations, you get a renovation loan, and you can kind of categorize them by what you necessity And then, you know, optional and what your budget can handle. Consider learning how to do minor repairs, like DIY stuff. You know, there's tons of YouTube videos out there on how to do stuff. And then or time to get professional help, particularly when it comes to anything electrical. I do not touch that stuff at all. And then long-term planning. Wait, what are you going to do with this property? Are you looking at just building equity? Are you looking at doing either a short-term rental, long-term rental later? If you're going to buy another home as your family expands and then rent out this one or sell it, you need to have a plan for that stuff, right? How do I keep my house in good shape? Number one, home maintenance. We're looking at seasonal maintenance, like when it comes to roof, gutter, lawns. Monthly, you want to check like your smoke detectors, and you check for any leaks, swap out your filters, things like that. And then when you come like an annual basis or HVAC system, you check your foundation, you clear out your dryer vents, things like that. So that's a routine maintenance. And then you're going to look at common repairs, right? And we have this electrical, plumbing, structural. That's when you can typically get a contractor to help you out. Preventative measures, water damage prevention. If your paint is peeling, you're going to want to redo it in order to protect the wood that's underneath, because you're looking at rot, bugs, termites, things like that. Pest control, you know, we get sprayed every quarter here. Fire safety, making sure like bushes and hedges are trimmed down to manageable levels, things like that. Also having basic tools on hand and safety gear, you know, sealants, paint equipment, things like that that you need to touch up. Particularly if you do short-term rentals like we do, we're constantly touching up stuff. It's not all roses, you know, it's not all the time. You know, there are some downsides to doing rental, but overall, it's definitely worth the hassle from our end anyway. And then you want to budget for maintenance, right? And that could be anywhere from 1 to 3% of the value of the home, depending on how old the home is. You can go higher in your annual maintenance cost budget, and you want to be able to track your expenses. So these are all the classes that we offer. That credit score class and that budgeting class are great, fantastic supplements to this class, because it really goes in depth in both of those subjects to get you really on your best possible foundation to purchase a home. I highly recommend it. It's something that we do above and beyond what other lenders may do, because we want to make sure not only can you afford the payment, but I don't want you sweating it. I don't want you sweating the budget and your payment. I want to get you in a good financial position before you buy. Thank you all so much for attending this class. I'm really hoping to just come and continually refine these classes to increase the value. I hope you do attend those other classes that I have. Again, all completely free. You know, there's no high pressure sales, anything like that. I'm not going to try to like sell you on a 3-day retreat or something you pay for. Nothing like that. It's all free, no obligation. I'm just happy to help where I can. So with that, we're going to end. Thank you all so much for joining, and hopefully I'll see you guys next week or even next month. All right, take care, everyone.